Goldman Sachs just put out a statement this previous weekend saying two things. Number one, that higher interest rates are going to contribute to a slowdown in our economy. And number two, even if inflation begins to fall, don't expect interest rates to fall. Starting with the topic of the economy, what Goldman Sachs said in their statement is that higher for longer interest rates will likely shave 0.5% from our United States economic growth, and it may force unprofitable companies to begin cutting their workforce. AKA, these higher interest rates are going to have more of an impact on our economy, and the impact that they can cause is more unemployment. Which brings us to the topic of, well, why are we raising interest rates? The Federal Reserve Bank has been raising interest rates to fight inflation. And so the thought has been, if inflation stays on this downward projection, then you would expect the Fed to start cutting interest rates, especially if the Fed feels comfortable that inflation is tame at around 2%. We're not there yet, but that's what people have been thinking. Well, this is where Goldman Sachs says that even if inflation falls, don't expect interest rates to fall. Here's what they said. Quote, markets have become less confident that falling inflation will be enough to prompt interest rate cuts anytime soon. Now you might be wondering, why is Goldman Sachs now saying that even if inflation falls, interest rates might not fall? Because you have a lot of people waiting to buy a home, to buy a car, to spend money, waiting for lower interest rates. And the thought was that if inflation falls, interest rates would fall. So where is Goldman Sachs getting this information from? And this is where what they're saying is that we are entering a new phase in our economy of higher interest rates, because for the last number of decades, we've been in this low interest rate free money economy, and now it seems like that might be changing. Now, this is where, if you look at what's been happening recently with the jobs data, it's very interesting to see what's going on with the economy, jobs, and inflation. And what we saw late last week was that in our latest jobs report, we hired way more people in America than what was expected. The latest jobs report said that 336,000 new jobs were added in America, which is almost double what was expected. Now, normally, this would be great news. It means the economy is strong, it means that employers are hiring, they need work. But in this phase of our economy, there's a lot of negative sentiment when you see a strong jobs number. Why? Well, let me show you. There's two things that you need to understand about this latest jobs number. Number one is that although we're seeing growth in jobs, wages are slowing pretty significantly. And number two is, even though we're seeing a growth in jobs, that could make the Federal Reserve Bank's fight even stronger, even harder. So starting with wage growth, here's what CNBC had to say. Average hourly earnings for workers rose 0.2% from the previous month and 4.2% from 1 year ago. So wages have increased by 4.2% year over year, although inflation has been, in many cases, higher than that. And while that's solid, according to CNBC, this increase in wages was smaller than anticipated, and it is the slowest one-year pace since the pandemic started. AKA, wage growth has been slowing faster than inflation has been slowing. And this is where now the question is, well, what does a strong job market have to do with inflation? Let me read you directly from CNBC. They said, quote, policymakers feel that a tight labor market will continue to put upward pressure on wages, which will then push prices higher. Now, I will link the CNBC article for you down in the description. I'll also link for you the Goldman Sachs report. But this is where now understanding the higher than expected job growth might seem like good news, and it is in a normal economy. But we're not in a normal economy because we're in an economy where the Federal Reserve Bank is working to fight inflation. So when you have strong job numbers, that's bad news for the Federal Reserve Bank, because the Federal Reserve Bank wants to increase unemployment. How do we know that? Because the Federal Reserve Bank keeps saying that they want to cool down the labor market. What does cooling down the labor market mean? It means higher unemployment. So now when you have CNBC saying policymakers, meaning the Federal Reserve Bank, feel that a tight labor market, meaning lots of people with jobs, meaning low unemployment, will continue to put higher pressure on wages, aka people are making money so they can spend money, which will then push prices higher. Meaning because you have money to spend, that keeps this economy moving, and because people still have money to spend, the prices of things will continue to rise faster than expected, and this is where the Federal Reserve Bank is trying to break that. And the way they want to do that is by loosening or softening the labor market. Now, what does that mean? In non-politically correct terms, that means the Federal Reserve Bank wants more unemployment. And this is one of the things that they're working towards with higher interest rates. Now, go back to what Goldman Sachs says. Higher interest rates are expected to stay around for longer than expected. They're expected to stay around, according to Goldman Sachs, even if inflation falls. And the higher unemployment or higher interest rates could lead to then more of job losses, more layoffs of companies, especially the ones that are struggling to make money, obviously. Now, we've been covering all this in Market Briefs. Market Briefs is my free financial newsletter. If you've not joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in things like the economy, interest rates, the job market, the housing market, stock market, and everything in between. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you've not joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. Now, if we shift gears and talk about what's going on in the economy right now, we're still seeing a lot of growth in the economy. The economy still looks very strong. Now, how do you measure that? You look at spending. People are still spending money. Now, are there concerns? Absolutely. You're seeing credit card debt rise. You're seeing people dig into their savings. You're seeing people dig into their 401ks. You're seeing people tap into their home equities in order to keep spending. However, people are still spending, which means if you take a look at a snapshot of the economy today, it looks good. People are spending their money. However, there are some changes that you're starting to see happen. I made a couple videos on this in the past couple of weeks. Number one is what I like to call the fake rich is starting to change. Where are we seeing that? Well, you're seeing prices of things like used Rolex watches really start to fall hard. You're seeing the prices of kind of those mid-range luxury cars. And by mid-range luxury cars, I mean like your G-Wagons, your Ford Raptors, your low-level Lamborghinis. The prices of these used cars, your $100,000 to $300,000 cars are starting to fall. Yeah, they're luxury cars, they're supercars, but they're not your $500,000 cars and above. Why are these car prices starting to fall? Well, a lot of people who started to make decent amounts of money in 2020, 2021, paid a lot of money to buy these items, whether it was a nice watch or a nice car, and maybe they gotten a little over their heads and they want to sell. And so now people are trying to sell these quote unquote assets. And because now you're seeing such a large supply of these quote unquote assets on the market, you're seeing the price of these things starting to fall. Now, to mention the fact that about 40 million Americans have just been hit now with their student loan payments. Again, now, what is the impact of this? Well, everybody has an opinion, and I have my own thoughts, but I think what will be interesting is about 6 months from now, seeing how spending changes because of the new student loan payments. Again, I mean, they're not new payments. They're payments that were paused for years, and now people have to start paying them again. But now you have about 40 million Americans that have this brand new monthly payment. The question is, what is that going to do? And generally, it's going to hurt your ability to spend. I mean, it hurts consumption during a time where consumption is already being hurt because of the inflation. Now, have we seen inflation fall? Yes. Has inflation gone away? No. Has inflation hit the 2% target? No. Inflation is still hotter than expected. And inflation for a lot of the products that people need, like your food, your gas, your rent, the inflation for these items is more than the 4% that people have been seeing with their wage growth. So wages are growing, yes, but wage growth is slowing significantly. But the prices of things that people need are rising faster than wages. At the same time, you're starting to see that kind of initial shift in the economy. And where's that initial shift? Where the fake rich people are starting to sell off some of their assets at a loss to cut off some of their payments. And what was interesting is CNBC ran a poll with the question being, would you delay a big ticket purchase now due to student loans? And interestingly, 70% of the people that responded to the survey said yes, that they will be delaying a big ticket purchase, like a car, a home, a vacation, due to student loans. So again, we don't know what the impact of the student loan payments are going to be yet. We'll probably start to see it in the coming months. But this is where, for you, it's important to understand we are seeing a shift in the economy. Inflation is still around, which makes consumption more difficult. Jobs are still strong, more fuel for the Federal Reserve Bank to continue raising interest rates. We are seeing a shift in how people spend their money. And not to mention the fact that the Federal Reserve Bank is still adamant on keeping interest rates high and potentially raising interest rates again before the year ends. All of these things are going to have an impact. This is why we're getting closer at the end of 2023. But this is why I keep saying 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. Because what we're going to see happen is as people have to make the decision of, okay, where do I cut back on my spending because the prices of things keep rising faster than my incomes? Eventually people will have to say, I can't keep going into credit card debt. I can't keep going into my savings. I can't keep racking up other sorts of debt. I have to make a conscientious spending decision that I have to stop spending because I can no longer afford to spend. When that starts to happen, you're going to see a slowdown in economic growth. When that happens, you will see an uptick in unemployment. When that happens, you will see an uptick in more economic pain. And when that happens, the Federal Reserve Bank will have to make a decision. Do you continue to fight inflation or do you fight the slowing economy? And this is where the Federal Reserve Bank says, today, they say that the number one focus is inflation. However, 2024 is also an election year. And so we know that while the Fed is supposed to be independent, they're not always acting independently, or so it seems. So this is where we don't know what's going to happen, but you want to be prepared for really anything. And this is where you can build your financial education and also work to build your financial preparedness.